Good morning.
Well, hi everyone. Am I on? I'm not muted. Everyone can hear me?
Yes.
See a few nods there. Terrific. Well, it's great to see everyone, and thanks for joining our first ever online seminar. We're certainly living in strange times, and it's great that we can meet like this, and great that things are starting to get back to normal a little bit. So we've been running an investment seminar in May every year for about 10 years now. And this is the first time we've had to do it remotely. Who would have thought that we'd all become experts in Zoom, but I think we probably all have over the last couple of months. So we've got about 60 attendees this morning, mostly clients. So as I say, great to see everyone, and also a few guests of clients as well. So if you're here as a result of an invitation from someone else, a special welcome to you as well. So it's just a couple of housekeeping issues that I should mention. Firstly, we are recording the seminar this morning for the benefit of some people who wanted to attend but weren't able to. So if you would rather your face not be on that recording for all time, then please feel free to switch your video off. Otherwise, it is actually great for us to be able to see the faces, but just letting you know that. Secondly, we will be having a short question and answer session after each speaker, which Sean will be moderating. So if you do have a question, the best way to do that is to use the chat function on Zoom. So on the Zoom app, press the chat button, select Sean O'Farrell's name from the drop-down box there, and then type your question in. The other option is, of course, when we get to the question time, if you'd like to actually unmute yourself and ask the question by the old-fashioned verbal method, then that's okay as well. But the chat is probably easier because you can actually do that during the session as your question comes up, and Sean can ask them of the speaker at the end. And at the moment, of course, we do have everyone's microphone muted. A few people have come in which I've had without it muted, and I've muted you. So hopefully we keep everyone muted, and that way we can just hear the speakers. Well, I think I've heard the word unprecedented an unprecedented number of times over the last couple of months. And when it comes to investment markets, certainly things have been moving at a very rapid pace, both down firstly and then up, at a pace that we haven't seen before. So it's at this time, this sort of period where quality investment managers can really help us when we're managing our investments. So outperformance is one thing, but reducing risk is another thing as well. So I don't want to take up any more time by way of introduction, because we have three fantastic speakers ready to give us some great insights into investment markets this morning. And I would like to thank all three of them, Chris from Magellan, Jay from Janus Henderson, and Rhett from Pengana, for giving us their time this morning. Now, all three of these guys are actually the portfolio managers. So they're the people that are pressing the buttons, that are actually making the decisions on the investments that end up in your portfolio. So I'll introduce Chris from Magellan first, and then I'll hand over to him. So Chris Weldon is a portfolio manager of the Magellan High Conviction Strategy and an assistant portfolio manager on the Global Equities Strategy, which is the one that we use predominantly. Chris joined Magellan in 2007, initially as a senior investment analyst working in the franchise team, and was promoted to become head of the industrials team. Chris moved to Magellan's New York office in 2015, and 1 year later left to join Davis Advisors as an analyst, and then rejoined Magellan in 2018 in Australia as a portfolio manager. Chris is a CFA charter holder and holds a Bachelor of Commerce and a Bachelor of Business Management from the University of Queensland, and is a member of Magellan's Investment Committee. So Chris, I'll hand over to you now, and I'll bring up the slides. Thank you.
Thank you very much for that very kind introduction, and thanks to the 60 or so people in the audience that have joined. That's an incredible number. So thank you for that. Thank you for the support, the ongoing support. What I will spend the sort of next 15 minutes or so doing is just giving an outline on how we're seeing the world at the moment, how we've positioned the global fund and high conviction fund portfolios, and then we can get into sort of some Q&A associated with one of the stock stories that we've got, time permitting. If you're happy to jump ahead, I think 2 more slides, I'm going to show you the macro framework. Yeah, that's the one. Perfect. Thank you. This is the macro framework that has really informed the decision-making and portfolio construction for us at Magellan since late February, early March. And if I think back to that time, we had at the time a pretty risk-on portfolio, a fully invested portfolio as we entered March. And then we started really connecting the dots and digesting all the news around coronavirus and the associated macro implications, industry implications, business implications. But it was really this macro framework that guided our thinking. And you can see there we've characterized 4 potential different macro scenarios, ranging from a sort of short and sharp to V-shaped cycle at one end of the spectrum, all the way through to potential depression-like cycles at the other end of the spectrum. And in early March, and you have to remember this was before any of the big sort of policy announcements around fiscal support and monetary policy support, we thought all 4 of those potential scenarios were very much in the viewfinder for us, for global economies, for global markets. And we thought the probability of all 4 were pretty similar, which is to say that the V-shaped cycle and the depression cycle and everything in between we thought was equally likely. And one of the core objectives that we have at Magellan, which I'm sure many of you know, is capital preservation in adverse markets, protecting your capital in tough market conditions. And with this macro view in mind, which includes, as you can see, some pretty ugly macro scenarios, which we were assigning meaningful probabilities to. With that objective in mind, we thought it was appropriate to shift to a much more defensive posture, which we did right across our portfolios in sort of early to mid-March. And I'll come back and touch on exactly what we did within the global fund, within the high conviction fund. So that was what we did in March, and that was very much, as I mentioned, informed by this framework. As we sit here today, in early June, we'd suggest that the V-shaped cycle and the depression cycle, so the 2 scenarios at either end of the range, seem much less likely today. The V-shaped cycle for most advanced economies seems pretty unlikely because so much time was allowed to pass. The virus spread so widely, so much of many advanced economies had to be put into that sort of shutdown and isolation that the economic damage just simply won't allow a V-shaped cycle. On the other hand, there might be a few economies that could have experienced something closer to a V-shaped cycle. And pleasingly, based on what we know and we've seen everything to date, Australia may be one of those. We seem to have done a pretty good job of managing the health aspects of this crisis and the economic aspects of this crisis. But there's plenty of water still to flow under the bridge. China might be another example of a country that could face something like a V-shaped cycle. And as I mentioned, at the other end of the spectrum, the depression scenario seems, in our minds, less likely today compared to how we were thinking about it back in early March. And that's because of some of the stimulus policies that I hinted at earlier that we've seen announced through March and through April. We had massive fiscal stimulus programs in the United States, in Europe, here in Australia, of course. We've seen a very substantial degree of monetary policy to support economies, to really make sure that this health crisis didn't cascade into an economic crisis and also into a financial systems crisis. And the Fed Reserve, the central bank in the United States, has been particularly effective in just making sure the plumbing of the global financial systems remains operational, that businesses can borrow, there's liquidity in the system, just making sure things don't cascade and become worse. But those policies have meant that depression cycle seems less likely today, which is a good outcome. So as we think about the world, we recognize it's still incredibly uncertain. There's still a huge degree of uncertainty with regards to future health outcomes. Will we have a vaccine? Will we maybe not have a vaccine? Will we have a successful therapeutic? When will those things happen? There's a huge degree of uncertainty with regards to economic outcomes here. We've got, as mentioned at the start of this call, unprecedented shock to the global economic system. We've got very elevated levels of unemployment. We've got businesses under severe pressure, households under severe pressure, and just how we navigate through this. There's still an enormous degree of uncertainty. And then there's still real question marks around policy. We've had pretty important policy developments to put a floor in terms of this economic cycle, but at some point further policy will likely be required to stimulate a recovery. And yet there will be hurdles to those sort of further policy announcements, and we're already seeing that in the United States today. And recently, there's been friction in the US Congress in terms of a third package to support the economy up there. And further policy, just given the size of the numbers and the increasing deficits and debt levels and those things, there will just be more friction through the policy channel as well. So a very wide range of outcomes still as we see it. But in our minds, at least, the probabilities seem to be shifting towards those two central cases, the U-shaped cycle or a prolonged, deep, multi-year recession, which is to say, we still see a pretty challenged economy ahead of us for quite some time. And that's why, we shifted to a much more defensive positioning, as I mentioned back in March. We still remain and still retain that defensive posture today. And if you are kind enough to flick to the next slide, what we've got here is the Global Fund as at the end of March. And I'll talk through some of the changes we did. But I just initiate this part of the conversation by highlighting that the portfolio has not changed very much since then. And that speaks to that very cautious macro view that we still have. The portfolio looks quite similar in its makeup today as it did to the makeup you can see there at March 2020. And so, speaking to that, in the month of March, we took cash from about 5% of the global fund up to about 17%. We did that in a night or two. We're very active in repositioning the portfolio and adding a lot of defensiveness to the portfolio. We did that by increasing cash. We brought down a lot of the risk settings within the portfolio. We were trimming businesses that have the highest degree of cyclical exposure and economic sensitivity. We were trimming businesses that have a high degree of non-China emerging market exposure. And we were adding to, some of our most defensive positions: utility businesses, infrastructure businesses, healthcare businesses, very high quality consumer defensives. They were sort of the things we were adding to at the margin. Cash increased meaningfully, and we really reduced our cyclical and economic sensitivity through trimming positions like Alphabet and Facebook. Obviously advertising, wonderful advertising platforms, but they are advertising businesses, which is traditionally a pro-cyclical industry, as well as trimming exposure to businesses like Visa and MasterCard. They have a very meaningful part of their business is exposed to travel. When folks like us travel around the world and we use our debit cards or credit cards, Visa and MasterCard earn some very nice profits on those transactions. And of course, with travel restrictions in place, not many of us are doing those sort of transactions at the moment. So there is a sort of short to medium term impact on those businesses. And then towards the bottom of the slide, you can see positions like LVMH and Estee Lauder, both sort of luxury brand companies in this economic environment and the economic environment we foresee. They're just less attractive, and they've got a bit more economic sensitivity. So we thought it was prudent to lighten up some of those positions as well. So that's broadly what we did in the global fund. During the month of March, was reduce cyclical exposure, reduce emerging market exposure outside of China, add to our defensive equity holdings. We also maintained some exposure to very, very resilient technology businesses like Microsoft and SAP, as well as the Chinese digital platforms, Alibaba and Tencent. We've got a case study on Alibaba, which we'll go through shortly. And then you can see a very meaningful increase allocation to cash and a small increase in the allocation to those very, very defensive, robust, steady, resilient equities that I mentioned earlier. On the next slide, we've just got the 31 March positioning for the High Conviction Fund. Within this portfolio, which is much more concentrated, as you can see, it's our 8 to 12 stock portfolio, our best ideas portfolio. We actually exited LVMH in this portfolio for the same reasons we were trimming it in the global fund. We exited it in the high conviction strategy. We also exited Yum Brands. And in this strategy, we entered a position in Tencent during the first quarter, really taking advantage of some of the price volatility that existed then. But then you can see the positions obviously similar in the names. You know, the US ad tech platforms, Microsoft, SAP, Visa, all those similar names there. But then look towards the bottom of the slide, you can see the cash in this portfolio increased very meaningfully. At the start of March, cash in the high conviction portfolio was also around 5%, and yet we exited the month of March much closer to 30%. And that's because cash in this strategy can flex all the way up to 50%, whereas in the global fund, we constrain it at a 20% cap for cash. So just given our very defensive macro views and cautious macro views, we wanted to be extra defensive in this portfolio as well. And we did that through cash and through trimming and exiting that position in LVMH and in Yum Brands as well. And then on the next slide, I'm just going to sort of finalize my discussion with a quick case study in Alibaba, which is probably a business a little less familiar to some in the audience, but I think speaks to the very high quality nature of the businesses that Magellan invests in, as well as the real resiliency that these businesses are experiencing in this environment at the moment. So Alibaba, just as a bit of background, providing some context on who they are and what they do, effectively they're a digital e-commerce marketplace in China. You can think of them almost like a combination of an Amazon and an eBay. But they are it is a very, very large business. So the numbers you can see on the screen here are already a little out of date. In the year that they've just finished, the 12 months that they just finished through to March of this year, in that 12-month period, their e-commerce marketplace just in China did processed over $1 trillion in transactions. So that's over 2 times the size of Amazon operating globally. Alibaba is facilitating via their website just in China, to give you some sense for the scale and the size of this business. The number of active customers in China is now over 700 million. It's nearly 730 million Chinese citizens using the Alibaba marketplace. That's nearly half of the Chinese population. It's about 10% of humanity. Again, just to provide some sort of some numbers around the scale of this business, it's breathtaking in its scope and how big and important it's become in the Chinese digital ecosystem. And then on the next slide, what we're trying to show is it's not just the e-commerce marketplace that is the most valuable and most important part of the business today, but it really, Alibaba has become almost like a super app where it now offers a range of consumer services and business services all within this digital ecosystem. So what we've got on the slide here is Alibaba's various businesses, and we're comparing that with some Western businesses, which most of us will be familiar with. So I spoke about their marketplace being very similar to Amazon and eBay. They also run an offline retail business, which would be similar to a Coles and a Woolworths business here, but they're very similar to a Whole Foods business in the United States for people who have visited that chain. They have the Uber Eats equivalent over in China. Then in their cloud computing business, they are the leading cloud computing provider in China. They are 3 times the size of their nearest rival. And that business, of course, very similar to a very large and very profitable part of Amazon Web Services, or Microsoft, playing to that very attractive long-term cloud computing thematic. Alibaba dominates that space within China. In the media and entertainment space, outside of China, of course, we have Netflix, we have YouTube, we have Spotify. Those same businesses, the equivalent of them in China are run, owned, operated by Alibaba. So very dominant across the digital entertainment ecosystem. And then they have very large stakes in some very important other businesses, particularly within the payment space, the Ant Financial business. You want to think of that very similar to the Visa and the MasterCards and the PayPals of the world. Alibaba owns 33% of that business. You know, probably the best positioned digital payments platform in China. So it's a very, very dominant, very broad business in China. There's nothing quite like it around the world. Amazon is probably the closest comparison because it has the e-commerce piece and the cloud piece. But as you can see on this slide here, it's Alibaba is like Amazon, but it's like many other businesses as well, all rolled into one. And wherever it competes in China, it is very, very dominant. And all of those industries in which Alibaba participates benefit from very long-term structural growth trends behind it. E-commerce growth over time, cloud computing growth over time, digital entertainment, digital payments, all those things are multi-year, if not multi-decade tailwinds behind this business that will allow for that compounding. But it's also been a very resilient business in the short term because so many of those trends have accelerated during this coronavirus period. Cloud engagement has obviously skyrocketed. E-commerce has benefited enormously with physical storefronts shut. During shutdowns and isolation, people have, of course, migrated to online shopping at an accelerated pace. So not only are these wonderful long-term trends in place, it has also been very, very resilient to short-term disruptions associated with coronavirus that has actually benefited this business. While so many other businesses around the world are suffering, big important parts of Alibaba have actually benefited from the coronavirus. And I think we've just got one more final slide on Alibaba, which just speaks to the valuation. You know, it's wonderful to find these great long-term compounding opportunities, but always at Magellan, we're very insistent on buying things with a large margin of safety, you know, at a big discount to what we think that business is worth. And just to summarize our view on valuation for Alibaba, again, these numbers are a little out of date and they're actually more compelling today, but the sort of headline price earnings ratio, price divided by earnings that the business will generate over the next year or so, is around 30 times. But if you then back out the cloud business that I mentioned and the Ant Financial business, which aren't making much money today to give it, they're at very early stages of their growth, and there's a lot of investment spend going on, therefore they're not very profitable today. You just back those out and assume those businesses aren't worth very much, such that you get a cleaner read on just what the pure e-commerce crown jewel of Alibaba is worth today. You know, we think it's being priced in markets at about 18 times, which is roughly where the US S&P 500 was being priced at around the same time. And you got to keep in mind, this is for a business that is much higher quality than the average market business, much favorable growth prospects than the average market business, more favorable risk profile than the average market business. So we just think a position in something like Alibaba, which is now one of the largest holdings across the global fund and the high conviction fund, is a very, very attractive investment. And it speaks to both the long-term objective we have for high absolute returns, but also the capital preservation objective that we have. Alibaba really ticks both of those boxes. So I'm going to pause there and sort of wrap up that part of the presentation and see if there's any questions.
Thanks for that, Chris. Can everyone hear me? You want to give me a thumbs up? Yep. Thanks, Craig. That was great information. I haven't seen any questions coming through in the chat. So has anyone would like to unmute themselves and ask a question, please feel free to do so. Otherwise, I've got a couple of comments and questions I might ask, but I'll just give it a couple of seconds for anyone to unmute and see if they want to ask a question themselves. Okay. So, look, I think there's some fantastic information in there, Chris. There's a lot to digest, but thank you for the stock story as well. It's always really interesting to see how you guys see the world, and I know that we've supported you for a long time. What's interesting to me, and I think it won't overview to some position. That is what we're talking about. It's early in March. My rough calculations would be that that would be hundreds of millions of dollars. Potentially.
Sean, you've broken up there. I'm not sure if that's just my audio or if others are.
That's across the board, I think. Try again, Sean.
Okay. I was just with the sell down and to taking to higher levels of cash. Is that audio all right?
Yeah, great. Thank you.
Then, Mike, rough calculations, you're doing that over a couple of days early in March. So could you put some context into how much money you were actually moving, whether there was any issues selling? I know you're at the big end of the market, so your liquidity was probably pretty good, but it might be interesting for clients to know how quickly, and 2 days is a long time to move that money when you're protecting their capital, which is your objective.
Yeah, it's such an important point, Sean, and something we get asked about all the time for the right reasons and with good intentions, because we are very fortunate to be in a position today. We are managing a substantial amount of money, so people want to know, can we move it quickly when we want to, like we did back in March? And the important answer is yes, and it's always been yes by design. When we think about our investable universe, the first and most important filter we apply is quality. We only want to expose our clients to wonderful businesses. But a second criteria, second filter on our universe is liquidity. We make sure that we only cover and only invest in businesses with a very high degree of liquidity, because infrequently, but from time to time, there are these sort of events where you want to move a substantial amount of money very quickly. And so, back in March when cash, and it happened frankly in a day and a half, we got most of the trade done in one night, and a little residual part of the trade happened in the second night. But when we took cash from 6% in the global fund to 17%, 11% of our global equities fund, which is, in US dollar terms, was roughly about $50 billion. We're trading over $5 billion in a night and a half. It's a pretty substantial trade. And we were able to do that through some wonderful execution by our dealers at lower than what's called the volume weighted average price for that balance of that trade. So the execution was very good. But the more important point is just speaks to the insistence always on a very liquid universe, because we do want to be able to transact in size if we think it's appropriate to. Unfortunately, we were able to do that back in March when we increased cash very rapidly.
Okay, thank you for that. We're running out of time, but I do have one other little quick topic. If you could maybe give this one 30 seconds. We're aware, maybe clients aren't, but we're aware that you have an expert consulting panel that you engage sometimes. I'm just interested if you could, I know Janet Yellen is on that consulting panel, so maybe if you could just spend 30 seconds, the final 30 seconds, just explaining to the audience why you use them and what help they provide.
Yeah, sure, Sean. So there's three external consultants that we engage with. The first, we've had a multi-year relationship with Michael Morrell, the former acting director of the CIA, and he's wonderful in terms of adding to our knowledge around geopolitical risks and geopolitical events. Very close to the election, to the political process in the United States. So a wonderful resource there. And then more recently, we've added Janet Yellen, as you mentioned, and then Kevin Walsh, who's also a Fed Reserve board member, and who, when Trump decided to pick Jay Powell as the current head of the Fed Reserve, the number 2 guy was Kevin. And so, of course, very, very experienced. Between them, have just a wealth of knowledge around monetary policy, views on long-term interest rates, which is so important in this world in terms of the valuation work and the fair price of equities and all assets, and just we are operating in an unprecedented monetary policy environment, and those two resources are incredibly useful in terms of understanding why the Fed is doing what they're doing, why other central banks are doing what they're doing.
Okay, excellent. I could ask lots more questions, but unfortunately, I think we've run out of time. So thank you from my point of view, Chris. I know you're a busy man, and we appreciate your time. Thanks, Mark, for helping put this together. And
No problems.
Thanks, guys.
Terrific. Thanks again to the Magellan guys. Great to see you. Great to get those insights. So our next speaker is Jay Sivapalan. Jay's the head of fixed interest, Australian fixed interest at Janus Henderson Investors. I'll just introduce Jay, and then he'll join us and go through his presentation. So Jay is portfolio manager and manages the Australian fixed interest portfolios. His responsibilities include formulating interest rate and sector strategies employed within the portfolios, and also working closely with key fixed interest clients. Jay joined Henderson in 2015 as part of their acquisition of Perennial Fixed Interest, where he was a partner and senior portfolio manager. He has a Bachelor of Commerce in Actuarial and Finance from the University of Melbourne, holds the Chartered Financial Analyst designation, and has 22 years of financial industry experience. So thanks, Jay. Over to you.
Thank you very much for that kind introduction, and please give me a quick thumbs up if you can hear me clearly and everything's working well. Good morning, everyone. Very good to speak with you today in what I would ordinarily call interesting times, but I think interesting is not the right word for the world that we live in today. But before I get started, I do want to sincerely thank you for your support, both the Fortunity Group as well as their clients. So thank you. We very much appreciate it. So my job today is to give you a whirlwind tour of bond markets and what we're seeing and what we're doing about it from a practical portfolio perspective. Just before we get started, for those of you who don't know us as well, just a quick introduction, a couple of slides forward, please.
All right.
That's got it right. Who we are, we're a collection of individuals sitting in Melbourne and the core of us have been together for about a couple of decades. For my part, just coming up to 20 years with the firm. And what do we do? We're essentially a full spectrum Australian bond manager. What does that mean? It means that we cover the full gamut of fixed interest as an asset class, you know, the sleepy but hopefully defensive and more secure asset class in your portfolios that acts as a ballast against your share allocations in your portfolios. We run a range of products, but today I'll be talking about the Tactical Income Fund that you can see on the right-hand side. And you can see the bulk of our products we've been running for at least 10 years, but in many cases, north of 20 years. Moving forward to the next page, and hopefully this will become evident of why we do what we do. We are an active manager, so for the benefit of everyone, what does that actually mean? It means that in times like what we've just gone through, March, April, May, we're very much positioning the portfolio quite differently to what you'd get out of the publicly available benchmarks or indices. And we're doing that for two purposes. Clearly to preserve capital, very similar to what Chris outlined from Magellan earlier. But secondly, and very importantly, for us in fixed interest or bond markets, these are 1 in 10 year events that causes and creates great opportunities. These periods are fertile ground for active managers to actually add value to your portfolios and to deliver better returns than what benchmarks would ordinarily do. Of course, in that, we do have to think through the noise and take a strategic focus. And we do that by utilizing a full range of strategies that we have available. So that's what I'll go through today. Just in terms of the product on the next slide, you can see that the Tactical Income Fund, what you're invested in, it's a defensive investment solution. So what do we mean by that? During a crisis like what we've just gone through, we want to make sure that the drawdown or the fall in value is very limited. It is absolute return in style. So we're not just paying attention to benchmarks. We're investing your monies the way we would invest our monies. And how do we do this? It's through active asset allocation to these different buckets or boxes, which I'll demonstrate today. So with that as a quick overview, let's jump straight into bond markets. One of the things that we found quite useful in communicating with our clients, but also internally in terms of thinking through markets, is really the observations that we've had through different crises in the past. The GFC is obviously the most obvious one. But then we had, the European sovereign debt crisis. Prior to that, we had the tech bubble, we had the WorldCom Enron period, and September 11, and so on. And the observations from those different crises, as well as many more in the past, before our time, was that the first thing that gives way is liquidity. So that's shown in the orange line. And that's when you get the big 10% falls in share markets and the really big negative headlines that you see in the financial press and other media and so on. And often that's the first to recover. And this time around, as Chris alluded to earlier, it was very much helped by what the central banks and other policymakers were doing. Then comes the market itself in the red. And that is really around the fundamentals of the market. What does corporate earnings look like? What does unemployment look like in the economy? How will that play out? The supply and demand fundamentals, the policy support from central banks. And then, of course, you've got the actual real economy, the blue line. And you can see how the blue line might translate. So this is the way we shaped our thinking, and this is what we expected, and it's very much playing out the way we've expected it. So I've got a time slot there at March and again at June currently. But we've still got, as you can see in the blue line, a fair bit of water to go under the bridge in terms of the real economy. And we do differentiate the real economy from what I call the big end of town versus the small end of town. So the large corporates that have got a lot of support, a lot of backing by central banks, and open and functioning markets, especially in our markets where they need access to capital, access to borrowing, and they've got availability to do that. Then the small end of town, your local florist, your local travel agent, the SME sector, the small to medium enterprise sector, who are going to, undertake a long and more drawn out recovery process that's going to take some time. What is important here to understand is that, as you can see, the markets start recovering much quicker and much earlier than the real economy. And in fact, as the defaults are coming through, and we do expect a default cycle through this crisis, albeit not a large one. But as the defaults are coming through, markets are very much on their way out. And it's very important to understand that when we're positioning portfolios. So moving forward, here's a quick whirlwind tour of bond markets and credit markets for investors in this space. And you can see, these are the times when you really get that quality before price and what really quality fixed interest means versus the lower grade fixed interest. Everything on the left-hand side is what we call investment grade and high quality and very much preserved capital. And everything on the right-hand side is what we call lower grade or lower quality fixed interest, which can over the long term deliver better returns, but it's highly correlated to share markets and had through March pretty significant drawdown. For our part, the vast majority of our products operate the types of results we're able to deliver for clients. And in particular, the Tactical Income Fund had a very small drawdown in March and fully recovered that drawdown in April, and then in May has outperformed and has been able to deliver for clients. Moving forward, now if we sort of step back into the economy, Chris earlier walked through the different scenarios that you could expect out of the economy. This is our base case, and there's a fair bit of information here, so let me give you a quick tour. In the grey boxes on the left-hand side is what the economy looked like in a pre-COVID world, and on the grey box on the right-hand side is what the world might look like in the post-COVID world. And of course, we're in the trough phase at the moment, and you can see it's a U-shaped recovery that we're expecting. A couple of important points. The exit point of that U-shaped recovery is a softer economy than the one we were going into, the coronavirus pandemic. So we will exit this with a high level of unemployment, as I said, a softer SME sector, and we'll need some policies to help us with that. The second point are those two bubbles. Stage one policies, is very much around what the policymakers have done to help us through this process. And it's very much around bridging the gap to get to the other side of the U-shaped recovery. From a central bank perspective, was it about stimulating the economies? Not really. It was very much around normal market function and liquidity. And then on the government side, was it around stimulating economies? Again, not really. It was around effectively welfare and bridging that gap. But now that we are starting to see the other side and coming out of lockdown, and as Chris alluded to, we're very fortunate and I think probably positively surprised by the lockdown and easing restrictions and how well we've handled things in Australia. And yes, we can have a second wave, but I think the way we'll deal with the second wave of infections will be a different type of lockdown now that we've learned what our hospital system can cope with, what we've pre-prepared for this pandemic, and then of course, how we can control and trace and track each other, especially if we have these outbreaks. So what we now need to start focusing on is those stage 2 policies in the bubble on the right-hand side. How do we go from what we expect is a 7.5% unemployment rate in Australia in a year's time and trying to get that down to something that looked more like where we were at the start of this year? You're already hearing murmuring from governments around the policy tools. And I think it will largely fall on the fiscal and government side rather than on the Reserve Bank of Australia and monetary policy, because there's not a lot more room for monetary policy with cash rates already at pretty close to zero, both here and across the globe. The initial discussion points are around providing some stimulus to the building industry, some stamp duty concessions, some first home buyer grants, etc. But we think we'll see a whole range of policies that will be rolled out over the next 6 to 18 months. And we need to be mindful of the winners and losers from those policies. There are going to be some permanent shifts, more onshore production, both services and goods. And then, of course, a greater level of appetite. And there will be some firms and industries that will necessarily fall into government hands from private hands. So they will be the losers, effectively, from an investor's perspective. And then there will be some industries that will actually prosper. Think about, data centers. Think about online and payment companies. Think about the broader financial services sector, etc. So moving forward, just a quick reminder of what it is to be a fixed interest investor. It's very much dependent on where we are in the capital structure of a company, especially when we're talking about corporate debt. When we talk about corporate debt, a typical balance sheet of a company starts with senior debt on the top, and then you get subordinated debt, then hybrids, which many of you will be familiar with, and of course shares and equity. The chart on the right-hand side, it may not be clear on the screens, but I'll just describe it to you. These are 4 securities, all issued by the CBA, $100 invested at the start of the GFC, and how they performed through that period. You can see that senior debt hardly skipped a beat. That's the top line there. And then you had subordinated debt, hybrids fell, and then of course shares, and then they recovered. 2 key points. When we're talking about high quality defensive fixed interest portfolios, we want the bulk of the investments in those senior debt. Second point, there are times when you have these crises that it may be worthwhile buying a little bit lower in the capital structure, like subordinated debt and hybrids. And we saw the same thing occur this time around. Let's go to the next slide. You can see here, and this time I picked on Westpac, again, 4 different securities through the COVID period and how they've performed. So again, senior debt has performed really well, held its ground, pretty much trading at 100 cents in the dollar, where we've had falls in subordinated debt and hybrids. But it has created that 1 in 10 year opportunity for us as active managers to go and pick up subordinated debt and hybrids at very compelling valuations, having already preserved capital being mostly invested in the orange line, which is the senior debt. Let's move forward. So there's a fair bit of information here, and I gave you a quick hint earlier about what it takes and what it means to be an active manager managing money on behalf of your portfolios. I don't plan to go through all of this detail, but the way we look at markets in fixed interest is on the left-hand side. It's a heat map of what we see as the opportunities. The darker the shading, the bigger the opportunity, and the lighter the shading, the lesser the opportunity. And then on the right-hand side, you can see the boxes represent our total capacity for taking risks on behalf of your portfolios and your money. And then the arrows and the shaded areas show our current positioning and what we've done through this COVID period. So a little bit different to what Chris was describing. In fixed interest, our portfolio today actually looks quite different to what it looked like pre-COVID. We've been very active. It's great fertile ground, and it's an opportunity for us to first preserve capital, which we were able to do through March and April, but now really hone in on the opportunities that we see against what looks like a very low yield world in terms of risk-free assets for the next 3 to 5 years. Cash rates are going to be hardly much above zero, and bond yields are going to be not much above about 1% at its maximum. So how do we go and deliver, 3, 4, 5% type returns? It's by taking advantage of all these different opportunities. In a fund like the Tactical Income Fund, we feel pretty confident that sometime over the next year, it should be able to deliver a return, given what we've done, of around 5% in an environment when cash rates are going to be very low. How we've done this? We've actually deployed a lot of capital. We manage about $14.5 billion in our team, and we've deployed in the space of the last 2 months about $2.5 billion, much of that in March through the darkest hours, which we think has really set these portfolios up. Let's move forward to where we've been deploying and how active we've been. Those 4 boxes that I showed you earlier, this represents the asset allocation of the Tactical Income Fund over time. I'll just get you to focus on the red and the blue areas for a moment. That is where we've made some significant additions, in particular the blue, where we've doubled our allocation to high yielding assets after they've sold off. Again, if we push forward, another area where we've been active has been in interest rate management. Now, without going into all the detail, if you just focus on the grey line there, that is a measure of how long we're locking in investors' monies for at prevailing levels of interest rates. There are times to be defensive and not lock that in for very long. So you can see last year we had a duration of around half a year. When bond yields were trading at very high yields, at a time when the RBA was looking to reduce cash rates, we actually locked in investors' monies for longer periods, more like 2 years. So that's the type of activity we do from an active interest rate management perspective. Just pushing forward to credit. This is really where we see the best opportunities for investors. Let me just quickly explain this graph. The grey shaded area represents the risk-free yield or the government bond yield over time. And as we know, it's very low today with cash rates being so low. The blue shaded area represents the additional yield or premium we get for lending money to high quality companies. And that ratio represented in the red line is shown is the ratio of credit spreads to government bond yields. It's the highest it's ever been. In other words, it makes a lot of sense to access credit and corporate debt. Now, of course, what we want to do there is make sure that we're not buying companies that have a high default risk. We want to make a very low default risk positioning in our portfolios and access some of those really good companies. But we think this is the main part of what investors should be investing in for the next 5 to 10 years as we deal with the low rate environment. Quickly moving forward. Let's move forward one more in the interest of time, please. So what are these businesses that we're lending money to? Where do we feel safe? Let's break it down into the left-hand side. These are all businesses that have a reason to exist, both during coronavirus and post-coronavirus. They're, sleep well at night type businesses. They're going to give us our money back. We're buying senior debt. Now, many of the yield to maturities in these businesses today, inclusive of the capital gains on offer, are in the area or the region of 5 to 7%. So here we are buying senior debt of sleep well at night type businesses, well-known brands, number one, number two players in most industries like Apple, Woolworths, Bank of America, Coles, that are likely to deliver 5 to 7% over the next year total return. Now, just compare that to what you had to do to get 5 to 7% total return at a fixed interest 3 months ago. You had to be buying much more precarious businesses and the senior debt or subordinated debt of those businesses. And if you are willing to take a little bit more risk, on the right-hand side, a whole bunch of businesses like QBE, Transurban, Sydney Airport. Clearly, airports and airlines are going to be a little bit more problematic for the next 24 months. But they are businesses that can deliver 9 to 11% returns for fixed interest investors. And that's why we feel confident there are a lot of opportunities for fixed interest investors that get thrown up in crisis like the coronavirus, like the GFC, and like the European sovereign debt crisis. What I might do there is I might just pause there in the interest of time and take any questions that you might have.
Jay, and some great information there. Does anyone have any questions? I'm happy to just, I've got one.
Sean, I think your mic might be playing up there. I might just get you to repeat that if that's okay.
Sorry, we couldn't catch that, Sean. So I think you said there were no questions. Was that right? No questions from the floor. Okay. I think in the interest of time, we might just leave that then. Thank you very much, Jay. That was a fantastic presentation. And I know the fixed interest area is something that's probably a little more confusing than the equity area for some people. So that was really well explained, and we really appreciate that. All right.
Yeah.
So great. So we'll skip through and go back one. Okay, so our final speaker this morning is Rhett Kessler. Rhett is the Chief Investment Officer and Senior Fund Manager with Pengana Capital. Rhett joined Pengana in October 2007, bringing with him over 18 years of experience as an investment professional. He's responsible for leading Pengana's Australian Equities team and managing the Pengana Australian Equities Fund. Prior to joining Pengana, Rhett was Head of Research for IAG Asset Management, as well as being a joint portfolio manager for various wholesale funds, totaling over $3.3 billion. Rhett was previously I've got a little bit of echo there. Well, there we go. He's previously a rated media analyst for UBS Australia, having emigrated in 1996, where he successfully managed wholesale and retail equity portfolios for Liberty Asset. Rhett holds a bachelor degree in Commerce and Accounting from the University of Witwatersrand in South Africa. He's also a chartered accountant and chartered financial analyst. Okay, Rhett, I saw your name down the bottom there in the participants, so I hope you've tuned in, and you are. I'll hand over to you.
All right, thanks very much. Can everybody hear me? Can I just get a thumbs up? Great. So thank you, and thank you for the privilege of being asked to speak at this conference. And it's good to see some familiar faces. I had a look at people that I saw, I think, at one of my previous presentations. Look, I'm going to talk a little bit about what the hell happened in March, how we emerged, what we did about it, and how we think about the world going forward. So it's quite a bit to cover in a short space of time, and I hope to take questions at the end. So if we just go to the first page, please. So if you just page forward. Essentially, I've put a team up. It's a small, concise team. I must say that in mid-February, we actually left the office to work remotely. I've been very impressed with the way the teams worked. Our technologies worked exceptionally well. We're finding incredible access to companies, not just in Australia, but all around the world, and analysts and conferences and specialists. And we really, I think, are viewing a fast forward into the digital age. And I say with a fair amount of chagrin that my team is probably working better than ever, particularly with me out of their hair. So if we go to the next page, please. So I'm going to give some observations and then the implications. So essentially we had a very exuberantly priced equity market, almost in a couple of days being replaced by fear and panic. So FOMO, fear of missing out, changed to just plain fear very quickly. It was exceptionally exaggerated by a range of market participants, including the exchange traded funds, hedge funds, industry super funds, and even sovereign funds panicking during that period, or their investors panicking during that period. I mentioned sovereign funds because just prior to Saudi Arabia going to war with Russia over the oil price, they essentially funded that war by selling out $10 billion worth of their equity holdings. The governments around the world have tried to induce economic hibernation, and it's worked pretty well in some geographies and not so well in others. And essentially they're trying to build a bridge across the lockdown valley, as I call it, to get to the other side. It's quite a deep valley in some cases. And what we found interesting is that certain members of the business community, particularly the banks, the big supermarket chains, even the airlines, have been co-opted into building this bridge. And certainly the big four banks seem to make a big part of that. Now, the implications is that, look, it's not for the faint-hearted. Forecast risk is off the charts. And anybody trying to forecast what's going to happen in the next 3 to 6 months, I think, is having a really tough time. We're focusing on things like who has the balance sheet to survive and who has the business model to survive. We absolutely believe that the strong will get stronger, and we absolutely believe that the opportunities for wealth creation are enormous. And we think that one of the key requirements within companies that we're looking at is that leadership. They can't just be competent and honest. They need to be resilient, and they need to have the ability to make decisions very rapidly. So if we go to the next chart, I'll just flip through these pretty quickly. So this is where we think we were in January 2020. The blue line is the share market. As many of you will know from reading my monthlies, Anton and I were getting increasingly frustrated by the fact that the share market just seemed to be running away from fundamental value. And so we were building up cash. We had a very defensive portfolio. We even had insurance, which is not something we do, quite honest. If you go to the next page. So essentially what happened was when the fear struck and lockdown hit, is that markets not only dropped back to fundamental value, but the fundamental value itself had to be rebased further down as optimistic outlook turned into quite a bearish issues. And so if you go to the next chart, we think that this was exaggerated by the panic and the liquidity events that were required. There were a whole lot of margin calls. As I mentioned earlier, there were industry super funds, and they're still ongoing, rebalancing their portfolios, being caught out. We saw a couple of hedge funds go bust, and this is not just locally, but internationally. So in March, it was a particularly tough time. I don't have much hair. I don't have much hair to lose, but certainly it's a very stressful time. We deployed about just over $100 million since the March and April, and we call that reaching across the abyss, and I'll spend more time on that in a little while. So if we go to the next slide, you've seen a very sharp bounce, and the real question is, are we back trading above fair value again? And I did listen into some of the earlier participants in this. Some are adopting a a very conservative outlook, and I think that's prudent. We don't try to forecast the market. We just look for individual good companies that we think make toilet paper and toothpaste type products for general consumption by the average consumer or business, and we've been finding lots of value. I must say that every time I go through the portfolio, I look long and hard as to what I can sell, because I'm generally a bearish person. But we keep finding things to buy, and I'll show you a bit of that in a sec. So if we go to the next slide, how did we approach things? We had a three-pillared approach. Cash reserves, we had about 18% in cash leading up to the market correction, and we took a lot of profits in stocks that, in hindsight, were incredible prices. We kept buying insurance, even though through put options, even though it felt like we were just tearing up money, but that's just what we do. And we had what we thought was a careful selection of defensive stocks, and there's a few of them. Particularly Evolution Mining is a gold mining company, and Viva REIT is a property trust that has 11 years of rental agreements with Coles or Shell. So if we go to the next slide, what happened when our initial approach to the big four is we started deploying cash very selectively. We started crystallizing our insurance at extreme levels. So when you buy put options, it's a derivative that makes money when markets fall. We spent about $1.25 per contract, and we bought tens of thousands of contracts in the good times. When things went bad, these insurance policies started morphing into very, very valuable instruments. So we bought them for about $1. We started selling our first tranche at about $4 or $5. We sold another tranche at $9, another at $12, and we managed to sell a big chunk out at $20 a contract. We've still got a quarter of it. It's only worth about $5 a contract now, but it's helped us, round out the rest of the portfolio. So we've got a balanced approach. And we started taking advantage of some incredibly attractive new opportunities. For the first time, we own Rio, we own Ramsay Health Club, James Hardie, Bapcor, Meridian, all at incredible prices. And then there was that plethora of very attractive capital raisings, where we managed to buy Credit Corp at $12.50. It's currently about $18. NAB in the $14. Ramsay, $56, currently about $80. Bapcor at half the price of where it is now. Evelyn Auckland Airport and a few others. We even bought some Flight Centre at $7, and they're currently $14. So there was a rush to market by companies, boards looking to shore up their balance sheets of the companies. And we were able to participate in spades because we had a lot of cash, and we had the psychological soundness of our insurance, which was acting as a real balancing factor in our assessment of risk. If you go to the next slide, the criteria we had for deploying cash is the following. Now, first of all, we want to have a company that's liquid, so we can change our minds if we need to. Absolutely, they must survive, both through business model and the balance sheet. We want them to emerge stronger, so we think that their competitors will fall over. We want to be able to buy them at a bargain. We can't predict the earnings for the next year, but we think we can for the first full proper year after COVID. And we're becoming increasingly positive about that. But we've been able to buy these companies on low double digits, so 11 or 12 PEs, which translate to 9 or 10% after-tax cash earnings yields. Incredible prices that we think we've set up the portfolio for the next 10 years. And then management, I've got a picture of Churchill there because they need to be able to go to war, essentially. And we've been amazed at how management have stepped up in some cases and how they've fallen apart in other cases. And, never waste a good crisis is one of my favorite sayings. You don't often get an opportunity to see the whites of the eyes of your management team under pressure. And this has been an incredible opportunity to see the caliber of the management teams that we have running our businesses. And by and large, we've been very impressed. Okay, so we go to the next slide. So how do we think things are going to play out? And so what I thought I'd share with you here is our methodology for doing this and some of the insights. Obviously not going to give away all our secrets, but as you know, that for every company that we buy, we have an investment thesis which tells us how we're going to preserve capital and make money. And so in trying to navigate going forward, we also have to have milestones against which we test our investment thesis. And so we've done the same for our strategy going forward. And so we've broken it up into 3 areas. First of all, the duration of the lockdowns. Now, we've had this process in place for 2 months now, and we've been very fortunate to have played largely as we predicted. So we felt that Australia and New Zealand would get on top of it, and we felt that the States would still be problematic. In terms of the lockdown, we think that the first bubble to be opened will be Australia and New Zealand for international. And we also felt that the government would try and go for some early wins, whereas they would take away the ban on elective surgery early. And that was one of the main reasons why we bought Ramsay Healthcare. And then for that bubble opening up, we think Auckland Airport will probably be best placed for that. In terms of the impact on the economy now, I'm probably not as bearish as others. I think that downturns typically happen and get worse because the governments in power at the time of a downturn won't admit early to their folly or to their mistakes in their economic policy, and they always stimulate too late. In the COVID-19, particularly in Australia and New Zealand, and in some places around the world, stimulus has been huge and early, even before the economy turned down. And so we think that there is a very good chance there'll be a sharp recovery. And then once the stimulus runs out, September, October, we're concerned about another downturn. So our real concern is around October to February, and then we think the economy will recover after that. We think there will be lasting changes to corporate or consumer behavior. We think that the digital economy has been accelerated by approximately 10 years, and this really benefits very administratively heavy companies like the banks, insurance companies, etc., where we think the digital processes will really eliminate a lot of costs. Working from home will change things substantially. Travel, particularly international, will be reduced. So we think there'll be a boom in domestic tourism, etc. And we've taken positions on that basis. So if we go to the next slide, the company I want to feature is Aristocrat. Just putting all of those things together. We had a position in it. We bought it because we thought the digital business wasn't being priced, but essentially for every dollar you put into this business, in normal times, 70 cents in every dollar is for the land-based gaming business and 30 cents is from the digital. We think it's a very good business. There's a global oligopoly. 3 or 4 companies run this industry globally. It's really quite weird. In 230 different jurisdictions where you sell machines, you first have to get licensed, which involves probity of your management team, and then your processes and your technology. And then for each individual game, you have to get licensed. And this is repetitive in every single jurisdiction. So once you've got all the areas covered, like Aristocrat have, there's enormous barriers to entry around this. So the big question is, all the casinos in the States, which is their main area, being closed, how the hell do they survive this period? Because they're not going to make any machine sales to them, and they're not going to benefit from renting the machines for the floor, which is a very profitable business. That's the land-based gaming business. Well, several things have happened in how we predicted this. First of all, the share price fell enormously because everyone was worried about this. But we found that their balance sheet was very robust. Their digital online business was actually growing incredibly fast because everyone was staying at home. And so we managed to buy this company on an 11 PE, not obviously the current year's earnings, but the future year's earnings, which is, we thought, ridiculously cheap. We've also been pleasantly surprised by the fact that as the casinos are opening, they're recording record volumes, particularly in the States. Now, it's very patchy to start, but certainly the customers have come back in size. To the extent that the share price has recovered, we've already started trimming it again. It's gone up about 30 or 40%. So I just thought I'd put that out as an example of how we think about things. There is no doubt that their competitors, both IGT and Scientific Games, have got incredibly stretched balance sheets, aren't able to offer the kind of support to the customers that Aristocrat has, and they've already started pulling back and winding back on their game development, which is critical in this industry. So I think I might leave it there. I think I've probably rambled on for quite a while. I've just put the portfolio up, and we've had an incredibly sharp bounce back both in April and May, and June has started quite well. We're within cooee of maintaining, and I don't want to jinx it, but maintaining our 13-year track record of positive returns every single financial year. The portfolio is well positioned in being set up for the next 10 years. We've managed to improve the quality at the prices. I'm astounded. I wouldn't have thought in January when we were buying those puts that we would get this, sorry, I'm a bit twisted, this lucky in terms of attractive shares, but we did. We did manage to reach across the abyss and buy them. I will stress that we've never had a lower cash level in the history of the fund. That's 5.9%. It is to some extent balanced by the insurance that we have, which hedges about 10% of the portfolio. So it's still within our normal ranges after counting that. But the portfolio is very defensive, very high quality, and yielding an incredible about that 8.1% has come down a bit, about 7.5% after tax cash earnings yield. So we're very excited. Anton and I have gone from grumpy and cranky to being quite excited for the future. So maybe throw it back to you for any questions.
Hi, Rhett. Thanks for that. I've taken Craig's spot because my audio was terrible. So can everyone hear me? Yep. So look, for the crowd, I think it's important to know that I've had a conversation with Rhett every 2 weeks, I say, on average, through this crisis. And early on, I think it's important if you could give us some views, Rhett, on you are an investor today, and I know how seriously you take that role as a custodian of the client's money. What were you going through when, how are you personally managing your personal process through this?
Yeah, I mean, I always say, that's a great question. I always say that my main role as principal of this business is not only to preserve capital and make money, but to keep everybody psychologically sound, including myself. And it was tough, when the fund was, I think at the low point, was down 30% in a month because of the panic and the fear. You start to question whether you've forgotten how to do this. But we've got a great team. We base our decisions on fundamentals. So we opened up every model and we went through them. We think that there was one or two out of our whole portfolio that we had serious doubts about. But I must say the cash and the puts, the insurance, gave us the psychological sound ability to hold our nerve, not panic, and actually add to positions. And what we've seen is this, as a result of that, is this incredible bounce. It's not easy. I can tell you, we call it reaching across the abyss because it's kind of like standing up after buying something. You've got to stand up and walk around your desk 2 or 3 times, trying hard not to vomit, because you're going to sit down and buy it another 5% cheaper. And you sit down and do that. And then, you do a lot of walking. But at the end of the day, when people are panicking, if you can keep your nerve, which is what we do, it really pays off.
Yeah. So thank you for that. And so at the moment, I mean, the current position, I think I said in a call a couple of weeks ago, when was the last time you had this amount of cash? I think you responded sort of 10 years ago to that question. So that shows your level of investing at the moment. How do you think it'll play out in September or October? Obviously, it's not a prediction, but
Yeah. Look, this to some extent, this is the lucky country. The only thing that's bothering me at the moment is just how strong our currency is, because that's acted as a real shock absorber. We had one of the record surpluses coming out for the first quarter, current account surpluses. Our iron ore, which is our biggest product by a country mile, is at record prices, almost record prices again. We've had a great agricultural season post the drought, so I think things will be booming on the food side, which is also a big component. We've got a lot of gold production out of this country. Bizarrely, we thought that tourism, which is one of our biggest education, which is one of our biggest exports, would create a real hole. But it appears that over 80% of the students that normally study in this country were already in country before the virus and those issues hit. So they're continuing on studying. So, as these data points emerge, we're becoming increasingly positive about the extent of the downturn. So how do we think it'll play out? I think there'll be a couple more roller coaster rides. There is a rush back into market as people are experiencing a bit of FOMO, and hence our cash levels, since the slide have started to build again into this very robust bounce back. And we're taking quite a bit of money off the table and putting it into our reserves again. So, exactly how it's going to play out month by month, we don't know, but we think that the strong will get stronger, and whether some companies like Telstra, Credit Corp, Waypoint, even NAB are incredibly well priced at the moment, and we continue to add to them.
okay. Craig just checked. It doesn't look like there's any questions from the crowd, but happy to take one now if anyone wants to ask one. So, Brett?
Sean, I've got one.
Yep, thanks.
You hear me?
Yes,
I
yep.
can hear you, Graham.
Yep. Hi. How often do you buy into a company with a short-term view that something pretty good's going to happen over 2 weeks or a month, with the aim of buying in and getting out, short-term trading rather than long-term, as it appears that you do go long-term with most things?
Yeah. Look, for the amount of work we do is quite extensive, and so the investment thesis has to play out. Generally, we do a variation of what you mean, is that if we like a company and we like the industry structure, we'll buy in with an expectation that it'll generate 10 to 15% over the next 10 to 18 months. And that's, we don't try to guess things. What has happened in the past, particularly with some of these floats, is that you've got the 10 to 15, sometimes 20 to 25% almost immediately. And then we ask ourselves, why are we there? We now think it's overvalued, so we exit. So that has happened on a couple of occasions, but it's tiny in the scheme of things. In a perfect world, we would never sell a company and only buy, because we have these investment milestones and we want them to continue to generate cash. If I can just take advantage of that, because I usually talk about this, but I didn't, is that we pretend when we buy a business, and this is our investment thesis, is that if we owned 100% of the business, how much could we as 100% owner at the end of every year scrape off, put in our pocket in cash without damaging the business, so next year we can come back and scrape off more. And we want to start scraping off at least 6%, and we want that to grow to 10% in 4 to 5 years with a high degree of certainty. And so you can imagine that if after 5 years we have a well-diversified portfolio of ever-growing annuity streams, so imagine going around to everyone and just scraping off 10% on our original purchase price, we think that's the way to get rich and stay rich. And that's all we think about. So yeah, we'll sometimes take advantage of some short-term mispricing, provided the underlying company is good and we want to own it further.
Okay, thank you.
Just see if there's any other questions. Otherwise, we'll wrap up. Okay, it doesn't seem like there is. So that concludes our seminar for today. Thank you, Brett, for the contribution. That was fantastic. Those insights into the way the Pengana Fund runs and how you guys think, and why it's been so successful over the years. So thank you, Brett, and thanks again to the other speakers. Thanks everyone for tuning in. It's been, I think, a great thing to do, given that we couldn't meet and have our normal seminar face to face. So I think it's been a terrific thing, and great to see so many people participating. Have a great day. If there's anything we can do for you here at Fortunity, please don't hesitate to ask. Thanks everyone.
Thank you. Thank you. Very good.
Thank you.